In this screencast, we're going to take a very brief look at two measures of performance evaluation: return on investment and residual income. The purpose of these performance measures is to get a handle on operational effectiveness in financial terms. Both return on investment and residual income are normalized measures of operating income, where normalized means that the original measures themselves are being recast in a way that is more usable for comparison. The definitions given on the slide are often fine-tuned to better fit particular circumstances, but they are a good place to start. The application of residual income and ROI that we're going to look at is to assess profitability relative to a particular investment and the opportunity cost of money. ROI and residual income can be used for projects, business units, divisions, and firms. Essentially, you can apply ROI anytime an investment is made and a return is the result of that investment. When ROI is applied to relatively self-contained business units, ROI is often defined as net operating income divided by sales times sales divided by operating assets. Net operating income divided by sales is called the margin, and sales divided by operating assets is called the turnover. The margin gives an indication of market power or product differentiation, and turnover is often related to efficiency. Residual income is defined as net operating income minus operating assets times the cost of capital. Operating assets times the cost of capital often provides a measure of the opportunity cost of the investment. Here is an example of a business unit income statement. We have sales, cost of goods sold, gross margin, other general administrative expenses, interest expense, income before taxes, taxes at 30%, net income. Total assets for the business unit are $10 million. However, non-operating assets are $2 million. And what we want to do is calculate a return on investment on a before-tax basis. Notice that we're going to end up subtracting out interest from income in order to get the operating income. The general idea is that things like interest, since they're non-operating, should be excluded from any measure of operating effectiveness. Similarly, non-operating assets are not expected to earn the same return on investment as operating assets. The whole point of the calculation is to measure operating effectiveness, so we want to isolate the elements pertaining to operations. Here I'm going to go through the ROI calculation step by step. Net operating income before tax is going to be the gross margin minus the other operating expenses, or $700,000. Operating assets are total assets minus the non-operating assets, or $8 million. The margin then is the net income before tax, $700,000, divided by sales, up here, $5 million, or 14%. Turnover is sales divided by the operating assets, $8 million, or 62.5%. So the ROI is 14% times 62.5%, or 8.75%. Some analysts prefer to do this on an after-tax basis. We proceed by calculating the net operating income after tax. So we take the $700,000 and multiply it by 1 minus the tax rate to get $490,000. So notice we're excluding the tax shield provided by interest. Operating assets stay the same as $800,000. The margin on an after-tax basis is $490,000 divided by $5 million, or 9.8%. The turnover does not change, and the return on investment after tax is 9.8%, times 62.5%, or 6.125%. To do the residual income on a before-tax basis, we need to know what the before-tax cost of capital is. I'm going to use 10%. Net operating income is the same as before, $700,000. Operating assets are $8 million. So the residual income calculation is net operating income times the $8 million times the cost of capital of 10%, and this gives us a negative $100,000. What this is telling us, since the residual income is minus $100,000, is that the opportunity cost assessed by owners for the $8 million investment is $800,000. Since net operating income was only $700,000, the actual operating income was less than the opportunity cost, and therefore we have a negative residual income. On this slide, I go through the residual income example, but now on an after-tax basis. Notice the cost of capital is reduced, since after-tax cost of capital would normally be lower than the before-tax cost of capital. I'm using 7%. Net operating income is $490,000. The after-tax income on the operating income only, once again, ignoring the effect of interest expense. Operating assets stay the same at $8 million, and the residual income is $490,000 minus the investment times the after-tax cost of capital of 7%. Once again, we get a negative number, in this case, minus $70,000. Notice that I've focused mostly on how to do the calculations, and that's a good place to start. You want to make sure, however, that you understand what these measures are telling you and how they can be used.